Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you a volatility play. This is going to be an option strategy to sell volatility. So when we look at option pricing, it comes down to volatility and time value. So those are the two main components. Now this is Pepsi, and Pepsi is going to report earnings tomorrow before the open. But it's had a pretty good move up, and we're above that 618 retracement. We're into the 200-day moving average, and we've got earnings tomorrow morning. So this has potential to move either up or down. Now, when we look at the option chain or the option series, what you can see is that here's the May 1 series. So this is this week's expiration, and you can see that the implied volatility is currently about 42.73%. And then you can see the series right behind it, the 8 May series, 11 days, is around 29%. So what stands out is that the front week, this one where the earnings will be reported, is higher in implied volatility of 42.74 versus the week behind it. So what we'll look at doing is selling this May 1 series and buying the May 8 series to take advantage of that, what we call horizontal implied volatility skew. So it's positive. So we're going to take advantage of that by selling it. And then we can also take advantage of the Theta Decay differential. If you look at the 135 right here, you can see that the Theta Decay is, hold on, let me put this over to Theta. You can see that Theta Decay is 24 cents a day on the 135, and on the 135 on the May series right behind it, it's 12. So there's about a 5 or 13 point difference there that we can play. So what we're going to do is tomorrow morning we'll see what the earnings do, and then we'll look to this volatility will still be elevated. So then we'll come in and look to buy and sell probably the same strike. So let's say tomorrow the earnings come in and it opens up right here tomorrow at 135. So what we'll look to do is we'll buy the 135 call for the 8 May series, and then we'll sell the 135 for the May 1 series, and that would be going around $70. So that's a debit paid. So that's going to be your max risk on the trade. And so that would put you into this trade, what we call a calendar. And if this goes out, let's say Friday the 1st, and it's trading right here at 135, this will be up, this potentially could be up over $300. And we've got a break even. The expected move is about 3.5–4%. So that's the downside potential target would be 4% up, would be about, let's call it 140. So this breaks even at about 139, 140. So 140 up here, or breaks even at about 130 down to the downside. So very low risk trade, but also very potentially high reward, potentially over $300 on a risk of 70. And this is playing volatility, selling volatility, and selling time. If you'd like to learn more about these types of strategies where we sell volatility, sell time, and a lot of different strategies that we can incorporate in our trading, especially in extreme markets, I'll be doing a workshop, free one, no cost, for tomorrow night, Tuesday night at 6 p.m. Eastern. So if you're able to make it, sign up, and hope to see you there. Good luck trading.